Today's call, we're going to be trying to quiz, I'm going to be trying to quiz Gurdeep on the journey of Standard Chartered Ventures. It's something I'm absolutely fascinated in. How do you go and take a really slow organization, and I'm not talking about Standard Chartered, I'm talking about banks in general, financial services in general are not renowned for moving particularly quickly, and put them into the 21st century where they're actually able to engage with startups, to move into corporate venturing, to try to go and develop products and services, to go and compete with the fintech revolution. Something which I've been fascinated about for years, ever since I've worked in banking, about how to go and do that, and something which I'm hoping we're going to learn a lot more about on this call. As always, please do ask your questions. This isn't something where I want to hog the questions for the next hour or so. It's something where we want to bring you all in. If you've got really good questions for Gurdeep, use the access opportunity to ask him what you want. We're also going to be bringing in Christian Lindener in a little bit. He's from Mach49 to get more of a consultant's practitioner's view to some of the points that are being raised. So with that, Gurdeep, welcome. Thank you for joining us.
Thank you for having me.
Let's start with the basics. What is Standard Chartered Ventures?
Standard Chartered Ventures is our venture building arm of the bank, of Standard Chartered Bank. And we are in the, I would say, in the business of new business building with the mission to rewire the DNA in banking. And in that process, we are not just transforming the business model of the bank, but we're also transforming and creating new business models for overall sector, which is banking. In support of our venture building journey and our venture building business, we also have what we call, I would say, an innovation arm, which drives innovation culture across the bank and helps the entrepreneurs in the bank become entrepreneurs. And we also have a fund which makes investments in the fintech partners we work with.
Sounds wide and extensive. I mean, I'll pop up the Standard Chartered Ventures link into the chat in a minute so people can actually have a look. But when I was looking through it, it's extensive what you guys do. You've got ventures, you're invested across different portfolio companies, you're trying to help entrepreneurs within the whole of the Standard Chartered group to get up and running with platforms. You've got engagement with clients. And then when I look at I suppose the technologies and the types of businesses you're invested in, that's equally wide and broad. You're invested in partnering with guys that are in blockchain, in crypto, in the lending side of things. Quite disruptive industries potentially for Standard Chartered itself. How, against that backdrop, how do you actually keep focused? You know, what is the vision and purpose of SC Ventures? Because when you've got so many things going on, it must be quite difficult to wake up each day and show, you know, this is actually the core of what we're trying to do here.
Right. And I think that's something which we have been stressing in our communication quite often now, which is we are at the heart, at the core, we are a venture builder. And that's very important, which is why the other activities are in support of our venture building mission. So they complement what we do in venture building, but at the core of what we do is create new business models. The second point I think which you made was in terms of thematics. Actually, we are quite focused on three themes broadly, and most of our venture portfolio actually fits within these three themes. So when it comes to focus, we are quite focused on two things. One is venture building, and the second is three themes, which are online economy and lifestyle, or digital banking and lifestyle. Second is SMEs and world trade. And the third is digital assets. These are our core themes. And if you look at our website, and you will find most of our ventures fall within one of these three themes. So yes, it does look like that we are trying to do a lot in terms of different activities, but actually they are all in support of our main purpose, which is venture building. And there's also a fundamental belief which goes behind having these activities under one umbrella. Having seen different business models of organizations, either they have a fund or they have, I would say, an innovation lab. Very few actually have venture building, I would say, in a scalable form. So they do have one-off ventures, but very few have venture building as a portfolio. Now, in many organizations, these activities sit within different parts of the organization. it was a very conscious choice to have these three activities sit within SC Ventures, because we do believe that there is power in bringing all these activities together, because as I mentioned earlier, that they complement each other with the main purpose of creating new business models and venture building.
How did that journey get started? I believe that SC Ventures is now approaching or just past its 10th year. You've been involved since the start. What was that process to actually get agreement and set up SC Ventures?
Sure. Actually, SC Venture is now, I would say, 6 years old. We started off in 2018. So we are 6 year old, which is still young. I mean, I would say from a startup, if you use a startup language, it is still quite young, 6 year old unit. But in these last 6 years, we have grown quite considerably. When you look at the number of ventures, and I think it's very important to clarify what do we mean by ventures. Most organizations use the word CVC interchangeably with venture building. That's not the case. CVCs for most organizations is actually just the investment arm where you take minority investments in companies. When we say venture building, we actually are incubating, launching, and scaling ventures which are majority owned by the bank. And these are almost like we have given birth to 20 subsidiaries in the last 6 years. And that number, whenever we have mentioned to other partners, they are actually quite amazed in terms of the speed at which we have been scaling venture building. So 20 ventures across the last 6 years is what we have launched across the three themes which I mentioned earlier. To your earlier question about how did this all start, it actually started between with a conversation between Bill Winters, the CEO of the bank, and Alex Manson, who is the CEO of SC Ventures, where they were debating about what is a very important element of driving transformation in the bank. And the business model transformation is what many organizations, in fact, if you read most recent research, whether it's from McKinsey or BCG or any of these other names, you will see that the CEOs of organizations are increasingly thinking about business model transformation. And 6 years ago, that was one of the main reasons what Bill and Alex wanted to do, which is drive business model transformation. And obviously, as we do that, there is another objective of driving the culture of innovation in the bank. But it was very clear between Alex and Bill at that stage, and I was behind the scenes helping Alex and Bill write the narrative, or I would say the blueprint of SC Ventures. So I'm quite close to it as one of the founding members from day zero, which is it was a non-negotiable that we don't want to just do innovation for the sake of innovation and create an innovation lab like many others have started on this journey. It has to be a very business outcome focus, which is you have to make it very commercial, and which is why new business model building was the anchor. I would say venture building, new businesses was the anchor around which other activities were built. So yes, have we achieved that objective, which is to transform the bank and transform banking? I would say absolutely. Um, some of the businesses which we have set up in the last 6 years, whether it is around digital assets custody and digital assets and markets, which is Zodia custody, Zodia markets, or creating a very different way to serve the SME segment and help with the supply chain management of corporates, or I would say even talking about banking as a service, which is our Audax platform. All these three businesses across the three themes which I mentioned are very new for the bank. So this is the first time we entered into these businesses. And as we did that, we were also one of the first few banks, I would say, which I would took a lead on creating digital assets infrastructure, which is bank grade in quality, but also attacking the SME problem, very different from just going after financing. We created a commerce platform and then embedded financing in the commerce platform. So yes, we have had success in terms of changing the mindset of the bank, but also the mindset of the partners and the ecosystem we have been working with.
What was there that precipitated these conversations? For people that don't know, I mean, I think you're talking about Bill Winters, your CEO, and Alex Manson, the CEO of Standard Chartered Ventures. What precipitated these conversations? Was it that Alex was particularly frustrated that he couldn't instigate significant change in transactional banking. His background, was it frustration that Bill had seen many innovation ideas try and fail? There must have been something which forced this conversation to become a reality.
Actually, I would encourage the audience which is listening to this conversation, and she calling to you, which is this exact conversation. In fact, the dialogue as it is, which happened, is actually now documented in the book, which is Nothing Ventured, Nothing Gained by SC Ventures. In fact, this is available now. We just launched this book a few weeks ago. So I would encourage all of you to get the actual conversation which transpired between Bill and Alex. It's captured in the first chapter of the book, Nothing Ventured, Nothing Gained. In summary, it was not driven by any frustration. Actually, it was kind of, I would say, meeting of minds. From Bill's point of view, at that 6 years ago, it was about moving to the next stage of the bank's journey. There was element of securing the foundation when Bill joined initially, and then it moved on to let's drive transformation. And from Alex's point of view, he had seen that if you are driving transformational change within a business unit, it has a different.
Picture's frozen there. I'm assuming that it's on Gurdeep's side, not mine. So it's probably a good time to bring Christian in. When you're listening to that, Christian, well, let's start with the intro because I want to then ask you about your perspectives on this separation and having to set up a separate venture unit. So, but before I can do that, can you just quickly introduce yourself, Christian, and tell me a little bit about Mach49 for anyone that didn't attend the last call?
Sure. Yeah, sure. And hi everybody. Nice to be here. In a short minute, we continue with Gurdeep. But a little introduction of what we do at Mach49 is basically this separation of venture investing and venture building, which all makes sense having it separated because they're two very different disciplines. As Mach49, we build and operate the venture builders, and we build and operate the corporate venture capital units for Fortune 500 companies like a Goodyear, like Airbus and TDK. We can also are able to build the ventures with our incubation and acceleration teams, and this is to drive meaningful growth for the parent companies. Gurdeep, he expressed this pretty well. Big companies nowadays, I mean, let's face it, they're going to be obsolete in now 15 to 20 years with the pace the world is moving. It can also be faster. Let's look at VW, for example. Business models are changing, technologies are scaling, and they're getting even more and more faster. So there is the need to innovate faster, and venture building and venture investing is two possibilities to drive meaningful growth for big companies. Now, this is what we do. This is the experience we have. And just touching quick and then giving back to Gurdeep, if we do work with big companies, we always get a CEO mandate to drive this. That's also the level you need to get to implement venture builders or corporate venture capital units to drive the transformation of the company. Along the way, we have a lot of ripple effects like cultural transformation. But I think the biggest KPIs is on the CVC, how much strategic and financial impact you make, and on the ventures being built, that they arrive at scale in a very speedy way, which Gurdeep can follow up. I think is not the easiest way in a big company, is it?
Gurdeep, are you there? Are you?
Yes, I'm here. I've unmuted myself.
Okay, so let's finish off what you were saying there about that, the early days of forming, Standard Chartered Ventures. We just got you cut off after you were saying that it's in the first chapter of the book, but there was a discussion, you wanted to change the business model, and then we lost you.
Oh, apologies for that. I was expecting Zoom to drop off once in a while, but hopefully it doesn't happen again. I was saying that there was a very clear expectation from a journey of the bank. There was, when Bill joined, it was about securing the foundation the first few years, and this next phase had to be transformation. And I think Christian just referred to the fact that there is an element of, if the business model of organizations does not evolve, then they are at risk, right? Even though many of these organizations, including our banks, are 160-year-old, there is a realization that banking, as we know, is changing rapidly. And if we don't keep pace with the business models and frankly lead with the change in the business models, then you will be at risk over a period of time. And that was one of the reasons why there was an alignment of minds, which is we need to do this, but we need to do this slightly differently rather than doing it within the businesses. We need to create a separate business unit because if you want the agility of like a startup, and if you want to apply a lean startup methodology and take through how a venture is built from ideation to acceleration to scale, that is better done in a separate unit. And
Why do
then,
you think that's the
yes,
case, Kadeep? Why? Lots of people say this, but why do you have to do it in a separate business unit? Why can't you have success using lean startup and being more progressive internally within existing business silos?
even even if you want to do this within a business silo, you will have to create a separate unit within that business. So that's very clear because the mindset you need, and a very important element is governance. The governance you would need to speed up venture building has to be a different governance from any large organizations. I'm not talking about this not the bank. I'm talking about any large organization which wants to do things which is venture building at scale and at speed. You will end up creating a separate governance, separate approval methodology as to how you are building ventures, and obviously a separate talent pool. Now, in order to do that, whether you create a separate unit within a business unit or whether you create a separate unit which encompasses all the businesses, and then you can do that, irrespective of that, you need a separate unit. Clear in my mind. I'm not advocating that you should always end up creating a separate business unit for the organization, but even if there is one business unit which wants to do that, which is absolutely fine. And I think I would encourage businesses to do that. But you will have to end up creating a separate unit because even the incentives which you put in place to drive that mindset culture has to be different from what incentives you have put in place for large organizations.
Christian, if that's true from your perspective, why are there so few corporates across the Middle East and Africa that seem to set up independent corporate venturing units? And there's an assumption there that my statement is correct. But when I look across Africa, particularly in financial services, I see very few Standard Chartered Ventures equivalents. I think we see Old Mutual down here in South Africa with Next 176. And then I look across and then I start to struggle. So is that true? There is a very limited amount of venturing that's going on across the continent into the Middle East, and if so, why? And what is it that you'd like to add to the points
Mhm.
there, Gurdeep? I just find it strange.
Yeah.
It's a compelling argument from Gurdeep, and yet so few people are doing it.
Yeah, so I mean, two questions here, and one. So what we saw being born in the US is that the venture building hype and the venture building wave rolled over the US first, like probably all the innovation units that came from there. Then we had the momentum, a short momentum in Europe, which then got interrupted by a lot of uncertainty and macroeconomics. So holding off investments in it because venture building is expensive. We don't need to hide that away. And now what we see now is a big momentum in the Middle East and North Africa, right? So this is where the hype is just, it's not a hype, it's beyond a hype, it's just because it has its value. It's just starting. So we are starting to get more and more demand, especially in the Middle East and Africa, out of two reasons. Middle East, because they're bold and they have ambition, they have capital. And Africa, because there's a sense of urgency as well. If we look at climate change, if we look at the youth of the continent, we have all the materials there that can drive venture building. As a prerequisite, actually, when we work with a client, we would not start working with a client if there's no sense of urgency, because that would lead into half-hearted innovation attempts. And industries like mining, oil and gas, financial services, they have that sense of urgency. So that would be the first part of the answering the first part of the questioning. It's just starting, and it's starting bolder then we would see it in the US and Europe. The second one, I totally agree with what Gurdeep is saying, and I even would bring it into a more extreme case. Always set up a separate legal entity to do venture building. CVC, nevertheless, is a separate entity. But you need to have different processes, different HR processes, even different IT stack than you have in the mothership. I mean, try stacking up Slack and Miro and stuff we use as normal or any SaaS solution in a big corporate. You would hit IT security and compliance and all the people you don't wanna exchange when you're doing innovation. So this is also what I did at Airbus. The first thing was to establish a separate legal entity that can hire fast, that can hire different talent pool. Have you ever tried to hire an entrepreneur in residence via the corporate processes? What they find, it's not going to be helpful. And having a different IT stack and also having different working contracts as well. In a venture builder, you need to be able to hire fast and fire fast or spin out fast. This does not happen in the if you're taking on the payroll books, especially if you're in Germany or any other European country. So yeah, if you do it, this might be polarizing, but I wouldn't do it inside of the company because it's very limited what you can do inside the big company. But this is my own personal view. Also happy to see others that have
Yeah,
been
Gurdeep,
successful.
does that resonate? Is that roughly what you were able to set up as a separate legal entity? My suspicion is that you weren't able to go that extreme. I mean, this is banking.
Your assumption is wrong, Colin. Actually, we are definitely set up as a separate entity, not only at the SC Venture holding company level, but all our ventures are separate legal entities. When I use the word subsidiary, they're actually separate legal entities, and even SC Ventures as a unit has been set up independent. Obviously, part of the bank group overall, but it is a separate entity. And that is exactly, I was smiling when Christian was talking about, because these are very, very fundamental points and these are non-negotiable points. It does not become obvious when you are starting, but experience will tell you that you need to lay these foundations before you even start. Because if you do it quite late, then pivoting a bank project into a company is not that easy and not that difficult. And for all the reasons Christian talked about, whether it is technology, whether it is talent, governance, as I mentioned to you, the governance word is such a big word. But how do you make approval decisions, funding decisions, are very different from how large organizations tend to do it. Which, by the way, just to be very clear, it actually it is the word I would use, it fit for purpose. So nothing against the large organizations doing the way the things they do, because I've been part of the organization for 14 years now, so I can see a lot of value in how large organizations move a big ship. But when it comes to doing things which are nimble, faster, you experiment, you pivot, you change course, and more importantly, there is an element of partnerships which is very core to how we build ventures. Now, there was an element of yes, when we talk to clients in the region globally, not just in Africa and Middle East, there is a lot of interest in doing venture building with us as partners. But how would you be able to bring partners into your venture if you are not set up as a separate entity? These ventures need to be successful beyond the mothership. And for that, you have to be open. You have to open the cap table for external investors, which could be a strategic investor or which could be a financial investors. And all of this cannot happen if you're not set up the way which Christian and I have been articulating.
Christian.
Yeah, just to again underline that, and I think there are a lot of people listening that are thinking about venture building or venture investing. Gurdeep said about minimum requirements, and we have turned down working with clients actually because they didn't have a CEO mandate. They would not be able to build a separate legal entity and do not have that sense of urgency. I would say those three things are the minimum requirement for companies to work with. I mean, a good example is aerospace. I mean, aerospace is brilliant engineers but do they have a sense of urgency? I mean, they're still going to sell 40,000 jets the next 10, 20 years, which is very challenging for our planet. But anyways, it's a functioning business model. So how big is your ambition to drive new business models? Yeah, just want to underline that how important it is. If you're thinking about doing that, just take into account all those steps you need to take.
I've got a great question here from Peter Swigers there, but we'll come to that just in a second. Something that I'm interested in is you've got the CEO support, you've set up the separate legal entity, and I didn't ask you, but I'm assuming you've been given freedom in terms of who you hire and the kind of platforms and systems that you set up. There must have been immense pushback from, I don't want to always pick on compliance, but there must have been immense pushback from compliance and some of the risk functions to try to go and bring you into the mothership. I always think, audit, internal audit, the risk functions are doing what they're pre-programmed to do. They're trying to protect the organization. And especially if you think 6 or 7 years ago when this is relatively new, was that a difficult conversation? And did you get much pressure from those guys?
Colin, I would say all these functions you mentioned are actually very integral part and partners, and I would say drivers of the success of SC Ventures. And you cannot do that without the support from each and every function in the mothership. Number one, very important. Number two, we are also very clear from the outset that we are in the banking space, which is, if not the most, one of the most heavily regulated sectors globally. And therefore, there are aspects of our venture building which we don't compromise on, which is we are building institutional grade capabilities. And actually, contrary to perception, this also becomes one of the advantages we have compared to some of the fintechs out there who are not necessarily built with a bank grade, institutional grade security and institutional grade governance. So actually, some of the things which we have not compromised on, and we will never compromise on, are the aspects which we have talked about, which is compliance and the overall risk appetite. But then your question is, what's the bridge? The bridge at the very beginning was the alignment and the mindset change, which happened not just within SC Ventures, but also happened within the mothership, which is it does require, and I use the phrase again, the governance which is fit for purpose. What are some of the aspects which we will not compromise on? And what are some of the aspects which are fit for purpose for a technology company and not necessarily applicable when you think from a banking sector point of view? Many of our ventures are actually technology companies. There are a couple of digital banks in our portfolio, in the overall ventures portfolio of the bank, which will definitely adopt what you need: bank grade governance and bank grade risk frameworks. But many of our ventures, which I have referred to, are not banking. They are technology companies which are in the space of banking. And that is where the difference lies, which is something which the organization had never done. But then they all came together. And now I would say it is working very well, where we have written down over the last 6 years now, we have written down the policies, the frameworks, the governance, the risk appetite. And that's how we also measure all our ventures. Now, this actually, the challenge you're referring to has become our differentiating strength, which is what gives comfort to other clients who are using our platform, because they would not use a platform which is not institutional grade. They would not invest in a platform which is not institutional grade. And that, as I mentioned, through the partnership with all the functions which we have talked about, has become a core strength for SC Ventures.
Oh, I want to bring Peter on. Hopefully you're there and able to use your microphone, Peter. Do you want to ask a question directly? It's always a bit risky doing this. Mr. Swiggers, are you there? What he's asked is, how do you bring the experience of the existing BU into your venture decision making and governance? And it's a great question. I know Peter set up a variation of the venturing type unit over at Standard Bank down here in South Africa. And this idea of going beyond compliance and partnering with the business units, we've got some other questions there as well. I think Christian's point, you which you just texted back, don't expect to make friends across the organization. And then Andre Hugo also talking about cannibalization. It strikes me that trying to make friends across the mothership is absolutely critical for this to work. And if that's true, how do you do it? Gurdeep, I mean,
Is that for me? So I just
yeah,
wanted to
yeah.
okay. See, there is an element of being realistic, which is in any.
Well, he's cutting off. Christian, you've got experience in this as well? I mean, you work with
Yeah.
venturing every single day of every week. Is there a set process, or is it basically you're off on your own and you just need to hide from the mothership?
Nah, actually, that's not the way it would succeed, right? So, if you get the mandate, it's a good start, and then you also need to just accept that you're not going to be everybody's darling, because you are cannibalizing the core business. You are going against existing products, and everybody will try also to push stuff into your organization, which is just not venturable. So the way we have seen it work is when we build it, is that we always build a new venture board where you have the sponsor, C-suite, and the business unit owner, and really show them what the value is, right? Because it can be a spin in or a spin out, always based on the mothership advantage, as we call it, the technology or customer reach that the mothership has. And then getting a buy-in from these people, that you're always going to have people there shooting against what you're building. Just expect that happens, but as soon as you start showing value, people also get excited. It's also a very exciting journey when we start building the ventures, because it's also something that is very different to the core business, and people like to be part of it. But you will always have people that are going to be against it, and I think that's like you have people like Gurdeep, probably stop me if I'm not sure, but a lot of stakeholder management is also needed, a lot of buy-in, a lot of candid buy-in from others, and just showing value, because it's easy to push around when you're the cool kid with the beanbags.
Look, an easy way to get support and buy-in is to give something up. So basically, to give, to get, to help other people is usually a good starting point to go and get, people to like you. I mean, Gurdeep, do you spend a lot of time trying to help the business units at Standard Chartered across the globe as they're doing their own internal innovation? And if not, what else do you do to try to get them to support you guys?
See, I think somebody mentioned, which is you have to make sure that you are adding value to the business, right? And one of the questions do we get is, are you building ventures only for the bank and only for the mothership? And the answer is no. The bank and the mothership, I would say the strategy is broadly aligned. However, bank is one of the clients of the venture. It definitely is the investor, but also one of the clients of the ventures wherever we can make it possible. Once a venture, and I would give the example of Zodia Custody, Zodia Markets, which were again new businesses for the bank, but they are actually powering the digital asset businesses of the bank also. And now there is complete alignment in terms of how we need to scale and build these businesses. The other thing we do is most of these ventures, in fact, all of the ventures, I would not say most, all of these ventures, on the board of these ventures, we have the respective counterparts either from the business or from the countries to be part of that board. Because then the ownership starts, which is, see, we have built a venture, it is a separate legal entity, it will have other strategic and financial investors in it. But when it comes to the strategic direction and contributing your experience, you have people from businesses and country CEOs on the board of these ventures. And I will quickly respond to one reflection, which I think, Colin, you shared earlier, which is how do you get the BAU to operate with a venture mindset? Actually, we have this concept of brain trust, which is we actually, for validating venture ideas, we absolutely need people externally who have done venture building to come and join what we have formed. I would not a committee, but a unit or a group called Brain Trust, where new venture ideas are pitched. And that is where you get external perspectives. And the beauty of this is that people from within the bank and the mothership also participate in that Brain Trust. So, in a way, we are also rewiring their DNA, because they get to think and listen from people externally.
Are
Same
you
applies with the board, because even on the board, we have external people or the INEDs who are from venture building experience. And that is where the ideation starts to grow and multiply.
Are you finding that's working though? Because lots of companies have brain trusts and they set up innovation platforms and they get people together and promise the fact that you put your ideas in and geez, if it's a good one, we're going to do the Amazonian thing and partner up and help you to go and create the next unicorn. And then they work for about 3 months and then die because people get despondent. They don't get the help that they wanted and they start to move away from it. Are you having some success with this?
Well, if the 20 ventures launched are anything to go by, the teams which have come up with these ideas are the ones which have stayed with the launch until the launch of the venture. Now, after that, it is not that the people have kind of given up. It is we keep on evaluating whether the ventures which have come from 0 to 1, 1 to 10, 10 to 100, what kind of talent pool does it require, like any other venture which in the market. So it's absolutely is working for us for the very simple reason that the brain trust is just one aspect where people get inputs on venture building and their ideas, but actually the actual work of doing the ventures is supported by the teams themselves. We do give them funding on a stage gated manner to go build the product, to test the product with clients. And again, the reason why they get a lot of support from the SC Ventures platform is we have on the platform, the SC Ventures platform, all the functions which are dedicated to SC Ventures and in support of the ventures. So he talked about compliance. It is a compliance of SC Ventures. There's a team for compliance for SC Ventures. There's a legal team in SC Ventures. There's a technology team in SC Ventures. There's a finance team in SC Ventures. All these teams, until the venture is mature enough, is actually supporting them. Even corporate secretariat, we have a dedicated corporate secretariat team for SC Ventures, which helps with the board management until the ventures are scaled and they're mature enough. So I can say with a lot of confidence that our model we have implemented for the last 6 years has been working very smoothly, and now we are able to scale and build new ventures at a very rapid pace.
I might test you on that smoothly in a bit. I'm sure there's been a couple
So
of interesting conversations over the years, but let's see how we
100%.
time. Maseko's got an interesting question here. He's going back and asking whether this is when you talked about the entrepreneurs and supporting them, are you really talking about entrepreneurs outside of the organization, which perhaps align with products and services where you can provide an off ramp, where you can support them, but there's some kind of relationship to the future of Standard Chartered? Or are you talking more about helping internal entrepreneurs develop products and services within the organization, or both? What can you just expand?
Yeah, absolutely. Happy to do that. It's both, because one thing which we, again, one of the questions we get all the time is what's the source of your talent? And for many of our ventures, the first CEOs of these ventures, for most of them, not all of them, for most of them, the first CEO or the venture lead has come from within the bank, the person who came up with the idea. As the venture progressed and evolved, we definitely have had different leaders take over the business and grow the business and expand the business. We definitely complement our venture teams with talent externally. I think, Christian, you refer to the tech team. So we absolutely believe that having the technology talent come from external or somebody who has done venture building and has been a CTO of a different venture, and then pair it with the commercial brain of the CEO is super important. Why do we believe that? Because you do need the banking DNA. Now, many of the fintechs which are out there, if you look at the founders, they actually come from the banks. Now, the argument we're trying to say is that you don't necessarily come up and say, I have set up a fintech, but you have no banking. You need that. What we're trying to do with the support and the platform we are providing is to bring out the entrepreneurs from the entrepreneurs within the bank who have the banking DNA, commercial mindset, hunger to live and die by a venture. And that is the support they need. So, in a way, it works very well for them because they also understand that if they were to set up the same venture outside, they would not get the support which you get by being part of the bank and being part of the SC Ventures platform.
Who makes the start stop decisions on these ventures. But actually, Christian, I'm interested in your view on this. I mean, what's your view of best practice for these types of decisions about which ventures to invest into? Because I've seen in practice before where the mothership gets a little bit too involved and they continually block ventures because they feel somehow they're too disruptive or potentially going to cause too much issue from them in brand reputation in terms of eradicating other business areas too quickly, and a whole heap of other reasons. Who should take the decisions here?
Hmm. I mean, at the end, in that case, the unfortunately hierarchy still works in a big company, so that's why we also have someone, a heavy hitter in the hierarchy within the new venture board, and they then take the decision. Normally not alone. You also have the business unit owner that benefits from it, or where the technology comes from. But normally that's the way decisions are being made. For example, for a company I built a venture builder on, I always need to go to the executive committee to take some decisions on investments or on venture builders that exceed triple digit million euro in investment, for example. But it's always about, I mean, governance is a very sensitive topic that needs to be thought through very into detail. Who can take those decisions, who's able to take those decisions, who has people or budget. This is what counts in the organization, and also has the mandate to do it. It's nice if it doesn't work, if it works without the C-suite, but normally you have the highest title that aligns then the other people in the organization. This is for venture building. For corporate venture capital, I think, to be honest, since this needs to be a separate legal entity, you would have different processes. So you would get your investment money, and then the MD with its partners would take those decisions, which also makes sense because that's where you're really going to invest into things that are disrupting the business, that are different to the business, that have a potential to drive a financial impact on the cost of your mothership. So that's again why the importance is so big on this being independent, with a ring fenced budget that no one can touch, because again, you're not going to make friends with this one. And another thing I wanted to touch on, because Gurdeep, you mentioned it along the way, the importance of having cap tables that are investable. Right? If you spin something out and you have a majority, it's just not investable. It's not attractive for financial investors, for venture capitalists. I would even say if you have more than 10 to 15%, it's not really interesting for VCs. So the founders don't have at least 80%. No one else will invest in this ventures, and this is nothing that you want to have, because you're going to need to budget this forever. But that again is a requirement, and the minimal requirement, that you need to be able to align legal and accounting and all these internal people, that it's okay to be a good minority shareholder rather than being a majority shareholder with limited power.
A similar model that you're running, Gurdeep. I mean, you said at the start that you like to take large investments in your new ventures, and is it a similar model that you're running in terms of decision making on the board to what Mach49 is suggesting?
So I would say slightly different, which is first is when it comes to decision making, it is taken by obviously our own investment committees and portfolio management committee, which does comprise of people from SC Ventures partners, and also a couple of people from the mothership who we believe are definitely going to add value in the decision making. So that's what we do so far. No problem. Obviously, on a half yearly and annual basis, the entire portfolio, what is the update on the portfolio, is given to the entire bank's management team, where people can have a view. But so far, it has been very independent in terms of building and what to start, what to stop, what to scale. Obviously, every organization will have their own threshold, which is decision making only has a threshold. As the ventures grow, the ticket sizes grow, and then you have to keep involving the right people who have the authority in the chain. In terms of the ownership, we have a different model, which is, remember I said we are building ventures from within, meaning we are not investing in an external founder led model. So we don't look for an idea and then say, let's find somebody who has an idea, because obviously it's their venture and then they have 80%. It is the entire capital is invested by the bank. We do carve out an ESOP for the the team, the venture team, and it's up to 20% for now. And therefore, you can say that majority of these ventures are owned by the bank. Now, we haven't had problems in getting strategic investors, which is the difference between a strategic investor and a financial investors. So many of our ventures already have other financial institutions or corporate partners who are part of our ventures already. And actually, they do understand and appreciate why you need to do that at the early stages. Do we have the intention to hold on to this stake? Absolutely not. As the ventures grow, the cap table will evolve. But we don't start with the notion to say, let's flip it and let's start with minority. We start with the majority stake. We do the fundraise with strategic investors and increasingly with financial investors. And our ownership of these ventures will reduce over a period of time.
It's a good time to bring in Nsembo's question there. I mean, it's kind of ideal timing. How did you come up with that model? I mean, an alternative is to spend your time looking for external ventures, investing, taking minority stakes, and trying to provide them with on-ramps or access or information and a whole bunch of other things, maybe technology. I would imagine trying to build stuff where you're incubating the idea internally and then driving it forward feels harder. I don't know why. Perhaps it feels. I suppose it feels harder because you're bringing it from within, and yet there's millions of fintechs that are sitting out there doing crazy things, who've already gone through those initial thought processes, maybe even have some sort of market fit. Whereas to actually build it from within. So anyway, but I don't want to put words in your mouth. What was the decision making for internally incubating rather than externally investing?
So as I mentioned, we do have a fund, right? So like many organizations, there is a fund which does take minority investments in, I would say, well-established fintechs already. Now, that is one arm of what SC Venture already does. So if you are trying to take a stake in an existing venture, that's where the fund model works. But I wouldn't call that venture building. I mean, nobody should call that venture building. That's venture investing. I think Christian also referred to it, which is venture investing, venture building are two different things. Now, the only question is in venture building, do you start looking for, I would say, very early stage talent who have an idea? So the moment they are mature, they become a fund category. That is something I would say we have not experimented with. Will we be open to do that down the chain? Yes. But I think the first few years, it is very important to do it to understand what venture building means. The institutional knowledge which we have now about venture building is absolutely, I would say, very precious and very important. Otherwise, if organizations which are starting on this journey, if they end up just taking 15% stake in a founder-led model and saying, let me help them, I am very open to understand from others later on, which is what has been their experience. Because you're not in controlling, you're not into shaping that venture. Your ability to build the venture, which is important, institutional grade, will be very limited because you can't influence the ICS, the compliance mandate or policies of the venture for it to be institutional grade. So for us, we believe it is very important to lay the foundation of the ventures in a very in a controlled manner. And once the venture is mature enough, you can dilute yourself as the venture progresses.
When you look back, Gurdeep, what sort of mistakes or what sort of things would you change? Because you said it's been smooth, but I imagine there's been lots of learnings and lots of issues that have occurred over these years. If you could go back in time, what would you do differently?
Yeah. No, but Colin, one correction. I said it's working smoothly now. I think it will be absolutely wrong to say that the 6 years journey has been a smooth journey. 100%. It's not has it cannot be a smooth journey. Not because of anything, because the main challenge is changing the mindset of the team itself, which is doing it. So the word mindset is very important. Organizations which embark on this for the first time, the team which is doing it, not only is their mindset changing, but you also have to change the mindset of others around you. It has been very hard. It has not been a smooth journey. It does remain challenging right now, but it is more of a strategic challenge rather than the operating challenge. So, from an operations perspective, how we build ventures, and which is why we have the confidence to tell other clients, other corporates, other investors that we are happy to co-create ventures with you, because we believe, not in a very arrogant manner, but we believe with experience, we know how to do it. And obviously, it will have challenges along the way. Now, you asked me if I was to look back and say, what would you do differently? The element of validation. How do you speed up validation? There's a compromise you always need to make, which is, do you build the ventures which is bank grade ready before you go to the first client? That is sometimes a non-negotiable when you have a subsidiary which is owned by the bank. And that takes, I think Christian also mentioned the very important term, which is, just to be very clear, corporate venture building is expensive, right? And one of the reasons why it is expensive is because you want to make sure that the first client, whether it is retail or SME or corporate or FI, who is using your venture, the product is ready from a governance, security, technology perspective, which is bank grade. Now, in that process, you lose a lot of time and you're not able to validate, the feasibility, desirability, viability. But I think I would say more from a feasibility perspective, you're not able to validate the demand as quickly as you need to. So I would like to find a way where my ideal dream state would be that the venture gets to validate with clients. And when you are in the scaling stage, you start putting in the bank grade governance requirement. But I don't think that's going to happen. It's like it will be a compromise. But if I was to look for my ideal state, what that ideal state would be, that is something which I would definitely try to do, which is validate first before um, uh, we make it a gold standard in terms of governance. The second reflection would be um, co-creating early on. What we have learned from the venture journey is that we built the first few ventures, I would say, alone, and then we took them to both clients and investors, and we were surprised with the reception we received, which is there was a lot of acceptance of the ventures, and people said, oh, if we have done this, why don't we co-create the next few ventures together? I would definitely be in promoting co-creation mindset very early on, and that does multiple things. You get validation done, which I mentioned to you earlier. You get validation done faster. You have more, you have a broader ecosystem to validate the ventures with. Second, you are de-risking yourself to a large extent. And third is the institutional knowledge you bring from either two banks or one bank and one corporate just enhances the overall proposition faster and better. So these are the two things I can think of at the top of my head, what I would do differently if I was to do this again.
Gurdeep, thank you very much. I think we've run out of time. We've hit the 5-2, which we set, and we tried to stick to it, so people got time to get to their next meetings. I just want to thank you both very much for joining. Christian, thank you very much for being here as well. And just before signing off, I'll be dropping out an email to everyone that was on the call and letting them know about a Mach49 initiative coming up later in the year. We're looking to do a 2-day course to help people to go and think about how to set up corporate venturing, what to do, what not to do. There's also a book that's out there from Mach49. Christian, what's the name of the book?
The Unicorn Within.
The Unicorn Within, which
Yeah.
although I can't remember the title, I read a month or two back, and I thought it was absolutely excellent in terms of laying out the structure that you need to think about if you're going to go and do corporate venturing and do it well. So I'll send that out as well on the follow-up mailers. With that, thank you very much to everyone that's dialed in. Thank you for the questions, and most importantly, thank you for our guests for taking the time to share their expertise. We'll see you all soon.
Thank you, Colin.
Pleasure.
Thank you, Christian. Thanks, everyone.
Thanks,
Bye.
everybody. Bye.